What's up, premium members? Welcome to low tap back, high tap back. This is going to be a quick one. Pretty simple concepts here. So essentially, um, what we're talking about is a Mark II, but not in a flip, just in a swing. So I'm going to go ahead and find some examples of that real quick. We can talk about. Actually, there's one right here. This is a perfect example of a low tap back. If you're looking at the 2 hour right here, this is a structural swing. If you don't know that by now, you're watching the wrong video. Go watch the other videos first, then come back. So if this had been a flip up, you would all be able to identify this as the Mark II. Because it was not a flip up, you can't identify it as a Mark II, but you can identify it as a low tap back. So vocabulary is very important when we're working on communicating with each other. And it's also important to note that there's a difference between Mark IIs and low tap backs. Mark IIs are typically just going to be more powerful for you in general. They're going to you're going to get more bang for your buck from Mark IIs, and low tapbacks have different targeting systems essentially. So on a Mark II, if this was a Mark II and I found an entry model, I would have a pretty good bias. I would be able to bet that I could target something up at the top here. Whereas with a low tap back, we are typically looking for opposing lower time frame swings. So for instance, if I was to take a low tap back execution trade somewhere off of this somehow, then I would be not necessarily looking for price to get all the way to the top, but I might be looking for it to make some sort of draw at one of these highs, or maybe a draw just back up at this high that it came from on the 15-minute, right? So still good trades, or maybe if you're, still using the invisible zone or whatever, like right there, you could drag it up and then let it hit right here. But the expectation, and remember the Mark II, low tap back, none of these are trading models, actual trading models. I'm going to be teaching the trading models in the next few videos. But as far as structural models go, the low tap back, typically we're not anticipating for price to get all the way to the same place that we expect on the Mark II. So to show a diagram type example, if you're trending down and you flip up, right, and then you tap back and then you go, that makes this the Mark II. Whereas if you are swinging already up, so you're just trending up, then each of these are going to be tap backs. So as long as they're not structural, because that would mean that you would have to flip down that time frame. So you're going to be looking for non-structural points. So the reason that this one is a good one is because we don't actually have a swing. We do have a valid high on the 2 hour, right? We have a valid high because of the closure below this candle on the 2 hour, but we don't have a swing. So if we were to get a swing, same thing applies as with the Mark II. If we got a swing up and then we came back down, we wouldn't be considering that low a low tap back or a point of liquidity to try to take trades from. We would be considering it just a flip down essentially. You're looking at a structural flip down at that point. But because the structure stays bullish this entire time, just like you would prefer with a Mark II, and you have a low tap back right here, these are good liquidity points to look for trades from. They also will very frequently align with things like this, like non-structural lows on the 15 or on the 1 or whatever, right? Whatever the time frame down is. So you're going to be looking and seeing, all right, we've got one point that is structural here, and then we've got another point that is not structural here. So one is likely to give out and one is likely to hold up, right? We actually come and pass through this line 2 times before continuing up. Let me show a couple other candlestick examples so that it's clear as day for everybody. So the 2 hour. Maybe I'll go to the 15. Maybe there'll be more examples on the 15. So come on now. I guess no, that's not one either. I mean, technically this, but this is not a good example. So let's find a different one. Here's an example, not of the trade actually playing out or there being a trade off of it, but here's an example right here where we tap into this. If we had stayed bullish the entire time and come back and touch this, this would be a place that I'll be looking for trades from. Okay, I did a little looking around to find another quality example, and I think that the higher the time frame, the more valid the concept. And so I thought that this was funny because there's actually a low tap back right here on the monthly. This monthly never flips down. Um, and once we close up above, the low point that we travel to before going higher is this guy right here. And then that big rando crash that happened between July and August all the way down wasn't so random. Actually, I just ended up going and taking out that low tap back, funny enough. And for some reason, that depends on if you have B80J on here or not, whether it takes it. But if you're looking at it from a continuous perspective, with the differences between the contracts, yeah, it does put you basically right there. Um, so there's one example as well. Let's go to the weekly. I know that there's going to be some examples on here. So on the weekly, we have a structural flip up right here. We have price staying bullish. We have a tap back right here. We go under it and then continue higher. So it's not perfect the first time. Notice how sometimes you're going to have a low tapbacks. This is why this isn't a video on trading models. This is a video on structure, right? The structure of low tapbacks is this, right? We're making our, oh, sorry, this is a Mark II. I'm being dumb. This is a Mark II. That's why it works so freaking well. Um, Damn, let me find one in the downwards direction. Here's one. So closure underneath our external low, okay? Tap back up right here. So see how we're trending down on the weekly? Man, wish we could turn back times. I want to be trending down on the weekly right now. And we make another swing, right? And then maybe this is also a swing here, but we touch and then go. So in this instance, right, we're touching the tap back into this swing, and I wouldn't necessarily be targeting, I mean, especially if this actually did flip up. I don't even know if I would take it, but if it was a really good lower time frame model, I think the max I would be targeting here would be down to the 50% of this right here. Um, let's see, we've got some more examples. Anywhere. So a closure above this swing, let's see, right here. And then here's a low tap back, perfect example right here as well. So again, we have a structural swing right here, according to candlestick and market structure. We touch in, we go out, we touch in just below this and sweep it out, and then we continue higher. So the low tap back is a really, really reliable tool if you know how to trade it and if you're on the right side of the market, if the market is remaining in that trend of the tap back. But if it's not remaining in the trend of that tap back, then I don't like it nearly as much. And then we've got little, again, similar things, Mark II examples right here, right? We close on that black candle, we touch right here and continue lower. And so when we come back up above this and get a nice flip down, then we have price traveling through the low that we came from. That's a Mark II. Same thing happening here with the low tap back. So there's a lot of similarities between the two of them, but we're going to get into how I trade them. in the next few videos, like I said. And, you know, structurally speaking, we're not going to be targeting the same kinds of moves, same kinds of levels. Here's another one. So this is actually looks like an SNDR one as well, kind of like that 1 minute example I gave you guys. But right here, we close, and then the low that we create to go higher is right here, and we hold structure, right? So we're staying bullish because we never get a pullback and a swing up. So we do get a pullback, but we don't get a swing up. So we're staying bullish on the weekly time frame. We come below this, we flip up most likely on the daily or do like a big double valid pullback or something with a higher low, and then continue to send out, right? So in this instance where we're at right now on the weekly, we have a big fat swing here. Our closure was technically right here. Let me see if there's any difference on V80J. So either way, B80J on or off, we definitely have a closure up above this. So that would technically make this that low tap back that sends us higher as of right now. So any questions, as always, please just message in the premium chat. Um, and if the structure stuff that I was marking out didn't make sense to you and you were thinking, why did he mark that as a swing? Don't but before you message, I don't want to discourage people from messaging and asking questions and stuff. But before you message me and are asking like, "Hey, wait, why did you mark this as that?" Just go and rewatch the videos. Go and rewatch the candlestick structure and the market structure videos. They're only 30 minutes each, and that'll explain to you why if you're still missing that. But and then rewatch the Mark II video as well. Okay, see you guys in the next one.